A. 0.65. A4080. A4050. 30% 45% 25%. /CH. N. Good evening, and welcome to our market wrap-up. Today, we saw a broad retreat across U.S. equity markets. The Nasdaq Composite led the declines, falling 1.34% to close at 26,021.66. The S&P 500 wasn't far behind, shedding 1.21% to 7,420.10, and the Dow Jones Industrial Average also dipped 0.98%, settling at 51,492.55. Market anxiety clearly escalated, with the VIX Volatility Index surging a significant 12.37% to 18.44, a move largely driven by the Federal Reserve's hawkish signals regarding potential interest rate hikes. Concurrently, the 10-year U.S. Treasury yield climbed 0.79% to 4.46%, and the U.S. Dollar Index, DXY, strengthened by 0.89%, pushing it back above the 100 mark to 100.39. The offshore Chinese yuan saw a modest appreciation of 0.28%, trading at 6.7742 against the dollar. In commodities, WTI crude oil gained 0.92% to $75.34 per barrel, while spot gold fell 1.5% to $4,283.60 per ounce. Even the cryptocurrency market felt the pressure, with Bitcoin declining 2.25% to $64,300. Looking at the broader global landscape, the standout performer today was undoubtedly the A-share market in China. The Chi-Next Index bucked the global trend, rising 1.56%, and the Shenzhen Component Index also advanced 1.31%. This independent strength was largely fueled by domestic policy tailwinds, particularly related to space computing, driving capital into aerospace and AI infrastructure sectors. Conversely, Chinese concept stocks listed in the U.S. faced significant headwinds, with Hexiantuo Network plummeting 13.94% and Waterdrop Incorporated down 9.28%, marking them as the weakest performers of the day. Today's market action can be characterized as a clear risk-off event, dominated by a flight to safety. Capital demonstrably shifted away from risk assets towards cash, short-term U.S. Treasuries, and defensive sectors. The simultaneous surge in the VIX and the strengthening of the DXY provided undeniable signals of this heightened risk aversion. The broad decline in U.S. equities, the VIX's jump of over 12%, and the DXY reclaiming the 100 level all underscore this shift. Energy stocks were pressured by negative news surrounding the U.S.-Iran agreement, while tech stocks continued to feel the squeeze from escalating U.S.-China regulatory tensions. Reviewing the global trading path, the Asian session saw A-shares defying the trend, a stark contrast to the U.S. market's open lower, close lower trajectory. The turning point for sentiment came after the Federal Reserve's policy statement, which quickly shifted market mood from mildly positive in Asia to decidedly risk-averse in the U.S. The sustained downtrend in U.S. equities during early trading hours confirmed the dominance of a risk-off logic driven by the Fed's hawkish stance. The VIX and the DXY were the primary drivers of this sentiment, while energy and Chinese concept stocks acted as major drags. Our morning report had anticipated a volatile market, and while it was generally accurate on the overall direction, it underestimated the extent of the U.S. market's decline, the intensity of risk aversion, and the sharp sell-off in Chinese concept stocks. The biggest expectation gap today was the A-share market's independent rally despite the depreciating yuan and escalating external tech restrictions. This marks 2 consecutive days of divergence between A-shares and U.S. equities, a trend that suggests a strengthening shift from globalized pricing to a domestic demand pricing logic for capital allocation. In terms of the trifactor linkage, while the DXY rose 0.89%, the offshore yuan only saw a modest 0.28% increase, indicating relative resilience for the RMB, possibly supported by inflows into A-shares. The divergence between falling U.S. equities and rising A-shares is a classic, fund switching, signal, suggesting global capital is marginally migrating from high-valuation tech stocks in the US to lower-valuation, policy-driven assets in China. The 10-year U.S. Treasury yields rise to 4.46% indicates increasing interest rates, which fundamentally suppresses valuation expansion for U.S. equities, particularly in the tech sector. Overall, the DXY and Treasury yields are moving in sync, signaling a bearish outlook for risk assets. However, the relative resilience of A shares and the yuan presents a contradictory signal. This implies that A shares' independent rally might continue in the short term, but we must watch if the DXY strengthens further above 100.5, which could retest the yuan stability. Looking ahead, we identify A-share traditional value and policy-driven sectors, such as aerospace and space computing concepts, as the strongest areas, with a 6.